Burgess and Bolton's weekly wrap-up.
Welcome everybody to this week's edition of Burgess and Bolton's weekly wrap-up, where we look at everything to do with the London market, technology and change and culture and everything else in between. This week we've got the news, and then we have an interview with Andrew McKee, CEO from the London market, very experienced, and we're going to get some insights from him from an interview that Ben recorded earlier this week. So that should be good. So let's kick things off. A bit of news as always to start. So I got some news, big news this week, Ben. Obviously, we got Brexit. It's not Brexit. We've got COVID. It's not COVID. It's the announcement that Harrison Ford's going to return in Indiana Jones. Fifth and final episode. And I don't know how I feel about this. I keep flip-flopping. I love the films, but I just think he's 78. You know, he's going to be too old.
Well, Joe Biden's 78.
Yeah.
He's the president of the United States, not just making a film.
There you go. So maybe it's really good. I don't know. But I always feel a bit uncomfortable when they remake another episode. Yeah. You think, actually, you know, that belongs in the past a little bit. But
I think it's like the Rocky films, isn't it? Sylvester Stallone, that was always a bit uncomfortable.
Yeah,
it's the old stunt moves. I'm not, you know, I'm always looking too closely. He's obviously not doing that, and he wouldn't, and he couldn't.
Yeah.
So no, and but you know, it's not that he needs the money, I imagine, but
must be just a lot.
Just a lot of this now, isn't it? Just older people, still doing stuff. I mean, in lots of ways, that's really positive. It is really positive. Shows that you can do it, but I wonder whether there's just a line
that needs to be drawn.
I mean, my father's not much older than that, and I don't think he could star in a Indiana Jones movie.
No,
even if he could act, which he can't.
No. Yeah. Well, let's hope they don't get him to fly the plane, because he's not very good at that, is he, Harrison Ford?
No, that's true.
Anyway. So I've got some more news. So I noticed this. It's a little bit old, actually, but I noticed that Ageas are using AI in pricing, underwriting, and we were talking about underwriting last week on the show, and I thought this was quite interesting. And the reason I picked it up is because I think there's been a shift in perception around how technology is going to impact underwriting in particular, because there was, you know, a year ago, this whole kind of clamor about whether AI will be able to take over the whole underwriting process. And I think that shifted. You know, it's much more about enabling the underwriter, gathering the information and the data in order to underwrite better. And that's essentially what this bit of kit does. You know, it's an algorithm that brings the risk criteria together in order to understand the risk better and price better. So I just thought it was quite an interesting.
It is, and Aegis is a good company for this. They've got a track record of using technology. They've got a system called Opal, which has been a type of quote and bind type service, which has gone very well for them. And they're not one of the sort of massive global players by any means, but they are really getting on board with this, and they've actually been a very successful underwriting business for many years. So it's good to see. And the other thing I notice about all of this now is just how much similarity there is in some ways between all of this technology. You know, when you listen to, obviously they all have differences, but in terms of the descriptors and what they're fundamentally doing, they are clearly beginning to get to grips with this. And in the end, it gets you to a point where it's a level playing field, isn't it? It's the technology will be the technology. You know, a bit of our algorithm's better than your algorithm stuff to market that. But in the end, it'll come back to the humans and how they work with these systems. But we are in that phase at the moment where the technology is going to be coming in, and it's really accelerating. Next year will be no different at all, I imagine.
Yeah, I agree. I think that is the case, and hosted a roundtable yesterday, and a lot of the conversation was around, I think I touched on it last week, around how customer preferences have changed towards messaging platforms rather than calling a call center, and it was good for both organizations and the customer because they could speed through those transactional inquiries or whatever the nature of the request was, but when it became you needed to speak to someone, you could free up those call centers to deal with the vulnerable customers or more complex inquiries. So I agree with you. I think that's the way it's going to go.
I think it's also the speed at which the technology moves, isn't it? And the fact that once you see the similarities, then consolidation becomes almost inevitable because people say, well, I'll choose that or that because, that's the standard. And I think the standards are really important. But as we know in our personal lives, they move very quickly. You move from one communications tool to the next, and then everybody's using it, and then it switches. So it's quite far. I wonder if it's going to be as fast moving in insurance, particularly in the trading sort of space, but potentially because there is just advantage to having a slightly better system than the next people, and also I still think that the communications piece is not well delivered. We've had Peter Clark from InsureCore on here, who's doing a great job in that area, but there needs to be more, and there needs to be great communications tools on top of these things, because again, that's all about the humans and how they work, and they'll definitely work with those systems that have those tools.
Yeah, good. Right, so that is the news. So let's move things on. So as I said at the top of the show, we do have a guest interview, and you interviewed Andrew McKee this week, Ben, for your...
Yes, I did. This is not the whole interview. We're just going to have a few clips as a sort of a bit of a teaser, but also because some of the points that Andrew makes are very well worth us picking up, particularly at the end of such a turbulent year. So for those that don't know, Andrew was he's by his own admission a veteran of the market, 35 years, I think, in the London market. He's actually now working at the moment on some startups, which we are under wraps, but we'll possibly talk to him about those next year. But he's been, for a long time, he was the CEO at Mitsui, and then he worked on the merger with Amlin, which became MS Amlin. And he's also, prior to that, he had a long time senior role at Chubb. And so he really kind of knows his stuff. And it was a really nice, interesting chat that we had about, where the market was, and to some extent what the sort of psyche was of the market. So do you want me to kind of tee these up, the first ones, each of these, as we go through them?
Yeah, I think so. I think the first one's around boardroom thinking, wasn't it?
Yeah, so it was just really obviously Andrew sat on these boards, he knows, and I know Andrew very well. We talk about all the dynamics of boards and how they work and how they think, which is really key in a trading market like this. It's all those conversations and where they land. And so this is the first question was really, what will boards be thinking in the current market? And this is Andrew on that subject.
Great. And I believe you had a new bit of kit, so we'll be able to see that as well in this video. So look forward to this, Ben. Cameras off.
At a very basic level, I think all boards will be... Probably their number one concern is, have we captured all of our COVID exposures, and are we adequately reserved? So I think that very immediate tactical response is what the board will want reassurance on, and I think that's understandable.
Yeah.
I think, and I hope that boards would then be taking a slightly longer term perspective. I believe in the old adage that you should fix the roof when the sun is shining. From the point of view of rating, the sun is shining. However, a hard market, it can do a number of things. It will absolutely help the balance sheet of underwriters. And Albert Einstein said that the most powerful force in the world was compound interest. Well, that applies to compound rate increases. And as we've already said, we're heading into the fourth year of rate increases. So that makes a huge difference. But I would hope boards would see through the actual impact of rate increase and realize that it can hide a multitude of inefficiencies and structural inefficiencies in a business. So what I hope a hard market doesn't do, and I think what is incumbent upon a board, is to ensure that whilst the rate increase is very welcome, that all the other initiatives in order to make sure that businesses are efficient and structurally aligned and interacting properly with their underwriters, that none of those things are neglected, because it's very easy to hide behind the rate increase and think that the world is perfect and everything is fixed within the house, when in fact now is exactly the time to not dampen the urgency to look at productivity, to look at efficiency, to look at how we interact with brokers. Now is the time to really double down on that.
Technology you've got there, Ben, those tapes, that's really good.
Like a gadget, and that is that's classy. That piece of kit really is. Yeah, I'm gonna get one of those.
I'll tell you what, that was really interesting that the hardening market can hide a multitude of sins, and I think that's right. And I've been speaking to a lot of people who are saying, margins are still tight. There isn't a lot of money around for investment in innovation or technology or whatever it is, and I don't know. I think if you don't do it now, when are you going to do it? Because it can get kicked down the road so often.
Very tricky. I know from talking to a number of executives over the years, and they've said no names here, but they've said, oh God, if we'd only just done stuff when the sun was shining and the rates were up, but we didn't. We all took the money and that was that. It is baked into the industry that's the cycle, and we almost we deserve something back. It's a very financially reward-driven industry, and that's one of the things they've just got to resist that temptation. I think that they will. I think that the big ones will. I think that you're right about this. They're still constrained, and there's a lot. Rate isn't going to do everything, and rate isn't going to. Andrew says elsewhere, rate will go on for the next 3 or 4 years. In his view, it will continue to be a hard market. But the question is it enough? And of course, you've got lower interest rates and or no interest really. And so that again, the fundamentals are different in this part of the cycle, and the world is still awash with capacity. So it's time for the industry, I think, to really look at fixing those structural issues.
Yeah, and I think let's see how the blueprint pans out. I think that is an important aspect of the whole modernisation.
Sure.
If nothing else, it's moving the conversation at least into that space and getting people thinking about it. So that's good. So next clip, kind of looking at underwriters. Is that right?
Yeah, well, we were talking about underwriters last week and some of the work that we've done. And when I heard Andrew speak on this, I thought, well, quite frankly, I don't know why we bothered doing all that work with Lloyd's, because he already had the model a few years back. And he talks about it here. No, I think it actually is amazing, actually, really how close the view of someone like Andrew, and I think others as well. I think we do get you need the evidence, but it is generally the view that this is what he describes here about the best underwriters is true. And I don't know why the market hasn't to date captured this type of stuff and doesn't use it more, because it's consensus really among senior people. I don't find anybody who disagrees with what Andrew says in this upcoming clip.
Cool. Well, let's have a listen. Here we go.
So going back and looking forward, what did you always see as the real attributes of successful underwriters? What really did you always feel, kind of behaviorally or characteristically made them good?
Yeah, it's a really interesting question, because there is no doubt there is a set and a blend of characteristics that differentiate successful underwriters who will always be in the top quartile, whether the market is soft or hard, and do it over a lengthy period of time. And it's really interesting to drill down into what those characteristics might be. We used to have a phrase or an acronym at Mitsui, which we thought, and I hold that belief to be true today, kind of summarized what defines a successful underwriter. And we called it CASE, C-A-S-E. Mm-hmm. So firstly, curious, a good underwriter needs to be curious about what's going on in the world. I'd like to see, if you walk past an underwriter's desk, that they're reading the FT, they're reading the Economist, they're thinking about the broader world and the macro economic developments that will eventually impact their world, irrespective of whether they're cargo underwriters or property underwriters or D&O underwriters. So curious, analytical. You have to be able to see the big picture, and you have to be able to live comfortably in the detail, particularly as more and more underwriting is becoming portfolioized. You need to be able to have the analytical skills to really drill down and interrogate that level of data. So curious, analytical, strategic. There's a time to grow. There's a time not to grow.
Yeah.
Frankly, many underwriters at the bottom of a soft market would be outperformed by a vacancy, meaning doing nothing is the right thing to do. And you need to be strategic enough to know that, or to know what parts of your portfolio you can grow and what parts you should just hold. I think portfolio management is really, really important, and the fact that decile 10 was seen as almost a revolutionary development at Lloyd's kind of was disappointing, because it should be the first thing you do, and it should be subliminally built into what you do when you're managing a portfolio. So curious, analytical, strategic in the way you manage your portfolio, and entrepreneurial.
All right.
And this comes down to the interaction with your brokers. You can have all the technical ability in the world, but unless you have commercial acumen and the ability to do a deal, it's not going to take you very far. And I think all of the successful underwriters embody those 4 attributes. And they also have a growth imperative. They recognize the need that, irrespective of the market conditions, you need to have forward momentum.
Yeah.
And you might have to cull parts of your portfolio, but you need to be smart enough and good enough to replace that with business that you're comfortable with at any given time. Yeah. So I would say curious, analytical, strategic, entrepreneurial, forward-looking, and recognizing that you need to grow and you need to progress your portfolio. And I'd probably add to that today, you need to have a mindset that embraces technology.
Yeah, 4 key principles there, like you said. Ben doesn't really, nothing to argue with there. Curious, analytical, strategic, entrepreneurial. It's what all our guests have been saying over the past months, isn't it? They're important. And then I think the technology one that he tagged on at the end is becoming, as we just talked about before, is becoming more important, and it will embellish all those initial 4 characteristics, and as we were talking about, enable underwriters to underwrite better, to make better communications, whatever it is. That's the role there. So it was really
I agree. I mean, I think it's a bit of a. He said there were only 4, rather like that Monty Python Spanish Inquisition sketch, wasn't it, where there was just one more that kept coming, but there was momentum and technology, and then just one more. And no, but I actually do think that he's right, and there's a couple of comments there. I think they're so similar to other areas that you work in. All my career, I've worked with people who've said, "Oh, so what do we mean by commercial then? What does that exactly mean?" I think we need to have this, again, I've used this phrase twice today, I realise, baked into these businesses, that these things are not niceties, that we've got to get away from just being the technical. We've got to get into saying, look, the commercial acumen, as Andrew described it, is what really matters in the end. It's the bringing together of all of these skills that you learn early on in your career and the technical stuff. By the time you get into your mid-career, you should be doing this. I'm afraid a lot of people don't do that. They don't move on from that enough. And I hope now with that technology coming in, they will, because it will need, technology will do a lot of that, and it will need people who've got that skill set, that commercial skill set.
Yeah, definitely. Right, we've got 2 more clips, so should we move on to the next one, which I think Andrew's commenting around the lead follow.
Yeah, it's lead follow, something that obviously was originally in the blueprint in Future at Lloyd's and was a big thing and got sort of pushed back. There are still things happening, obviously, with Key and other initiatives around follow markets and technologizing. But the lead follow thing here that Andrew's talking about is how important he feels it is to sort this out to compete, for Lloyd's in particular, to compete with the rest of the insurance market.
Great. Let's hear the clip.
I would be, I guess, a passionate advocate of that because I think it makes so much sense.
Yeah.
If you look at, the great strength of Lloyd's is the fact that it's a subscription market, and that risk can be divided out and shared, and hopefully that creates capacity. But Lloyd's competes with massive global companies if they're Allianz or Chubb. Now let's just take an example where one of those companies is looking at a £100 million property account. We have to put out a £100 million limit.
Yeah.
That company will do all of the things that you need to do to underwrite and bind the business. And say there are 20 tasks to do that, from reviewing the submission, from looking at the claims experience, from doing your due diligence, from running your pricing models, from doing your exposure management, from doing your sanctions checks. Say there are 20 tasks you have to do.
Yeah.
Not from quote to bind, from receiving submission to binding it. Then a big company will do that once.
Yeah.
If it's a £100 million property account, Lloyd's will have probably 10 carriers or 10 syndicates involved in that, who are each doing those 20 tasks for that one piece of business.
Yeah.
So that's 200 versus 20, or 180 more tasks that are being undertaken. And I'm being extreme here to make the point. So it seems to me a logical answer to that is that one lead carries out the bulk of those functions, and the rest of the market checks some of that, but it effectively acts as responsible follow, and those responsible follows are governed by a suitably calibrated set of minimum standards.
Yeah.
So to me, that just makes perfect sense. And I know it's difficult, and I know there's implications around headcount. It has implications for ego and status, but to me, it simply has to be, it is a very logical way for Lloyd's to reinvent itself and to address what is a real existential problem, which is the expense base.
Yeah, and I've heard certainly that, we've been doing some work on that with the brokers, and that is one of the big issues, and that why they're saying there is business that is just not profitable for them to bring into the market because of that reason. Yeah,
I think there's the operating expense, which I think for an average Lloyd's syndicate is 14 points, and I would say you could run a lean follow-only syndicate at 1/3 of that. Then there's the issue of the acquisition costs, which are too high, and that's perhaps a more complex and long-term problem. But if acquisition costs are 25 or 30 points, then for me it's difficult to say to a client who's paying the premium, 30p out of every pound that you pay for your insurance isn't available for you to pay your losses.
Yeah.
And makes a lot of sense, and it's what's been talked about a long time, really. It's surprising that it hasn't continued, as you were saying before, Ben,
to go to a restructured lead follow model. It's as Andrew alludes to there, it is a difficult one. It involves people's jobs, it involves big structural change, but the big points are that it's too costly now. The consolidation in the broking market, McGill's talked about this, said, how can there be so many leads? It seems a bit unlikely. There needs to be fewer leads, there needs to be streamlining. I think that word streamlining is going to be the word of the next 3 or 4 years, really. It's pointless. A huge chunk of business is just, renewed as churn every year. It doesn't need all of this expensive resource on it. And you want to focus on the stuff that you can win and bring into London, and keep the quality up and apply the skills of the market.
Yeah, definitely. And that leads us nicely into the last clip, where I believe Andrew's talking about the Lloyd's room.
It's just a bit of
it's
kind of a positive thing, and I just talked to Andrew about the chairman's statement that it might become a Costa coffee shop in future. Andrew does push back against this.
Let's have a listen. Here we go.
Owners said that it might just become a coffee shop again. Is
Well,
that possible?
maybe. I mean, I guess I'm a bit of a traditionalist, but surely the answer is a combination of electronic trading with face-to-face conversations, face-to-face discussions. I'll come back to what I said earlier. The strength and the differentiator for the London market is the intellectual capital experience that is present in the square mile. And I think a very important part of that is people meeting, sparking off each other, discussing ideas, innovating. So from my point of view, there will always be a place for the Lloyd's market and for people to meet face-to-face. But obviously you want to make those conversations as efficient as possible. And there's a big part of the transaction that can be done electronically. But I would always, I do not think London will remain differentiated and remain really superior in the way it transacts insurance if it doesn't capitalize on the fact that there's so much intellectual capital in such a condensed geographical area. But those people need to meet and spark off each other.
And another good clip kind of builds on the previous clip where he was talking about cost and expense, and then, where's the real value? It's in the people, it's in the connections, it's in the expertise. It's not in the process of underwriting and placing and whatever else. So yeah.
I think probably now my feeling is that after a year like this, we have settled really now on what the future shape of this market is. I don't think people are saying face-to-face is going to go away. It's going to be part of this. We're going to have technology enabling this. This was a vision of countless consulting papers 10 years ago, I suppose, but it's coming now to the market. So the vision, if you like, I think is there. We can imagine it. I suppose we just need a vaccine to work so we can all actually do it. A few other things. But wow, once that does, and if that does come to pass and it all goes back to some kind of normality next year, just imagine how energized the market is going to be for all this change. It's going to be amazing, I think.
I agree. I think it's amazingly positive once we get over this weird phase into the summer, and then probably this time next year it'll be very exciting again. So excellent. Well, thanks for doing those interviews, and that was really good. And people can.
Well, there's the podcast is going to be available. Yeah, sorry.
I was just going to say people can.
So we'll put the link in.
Cool. Excellent. Look at that. We're bang on time today. It's a first for us, isn't it? We're usually over.
Yeah.
by about 10 minutes or so.
It's the new efficiency, Jeremy. We're already living it.
Living the dream.
We're saving 40 points on the pound here.
Excellent. Right. So weekend activity. Well, actually, we should preview next week's show, shouldn't we? Because it is our Christmas end of year special wrap up, isn't it?
Yeah, we're going to do a quiz of the year. It'll be a competition. We're going to get some people, we hope, who are going to be in this competition. And so it's going to be good. It's going to be fun.
Yeah.
Quiz of the year. Bit of insurance, bit of global events. Hardly been any of those this year.
I can't think. That should be good. Something to look forward to. Not news. Weekend. Amateur. Right. So this weekend, are you doing anything? I'm not allowed to. I'm in total lockdown tier 3.
Not a lot, actually. I'm going to be doing some Christmas shopping. I'm behind on everything. I'm behind on work because everything's been compressed into this last quarter or third of the year, really. It feels so pressurized. I've got to just do so many things at once. I'll be glad, in a way, when we get to January. Yeah. Not always my favorite month, but so it's a bit of Christmas shopping. Decks are already up.
Good.
Electricity bill to come.
Looking forward to that. That is funny. I mentioned it before, but in the panel session that we ran yesterday, it was only yesterday. People, the fatigue on people's faces on the Zoom, it's just like flipping heck. And actually, I could tell there was a few people who were they had it on their iPad, but they were also working, on emails or whatever it is for the end of year stuff.
Yeah.
It's been quite...
I agree. I think it's very pressurized in lots of ways now, and I think people are really fed up, and I think they're looking at Christmas as a break. Interesting to see, but I do think people are very tired. Quite a few people I have spoken to have actually been ill with COVID, so it's that's on top of everything. Schools, my son's at home. It's tough. Yeah, it's really genuinely quite tough. And yeah, let's all have a nice break after we've done our quiz, obviously. Indeed, next week. Yeah. So don't all go off for your break.
Yeah, join us next week for the Christmas special. Right, thanks ever so much, Ben. Thanks everybody, and see you next week.
Burgess and Bolton's Weekly Wrap Up.